Welcome to GRE. I'm your host, Keith Weinhold. If you had invested $1,000 in JP Morgan in 1882, you'd be dead today. You'll get some perspective there. How real are today's recession fears, and what happens to real estate in a recession? The concerning proliferation of coffin homes in America, and more. All that today on Get Rich Education. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Anchorage, Kentucky to Anchorage, Alaska, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. I don't often start with something so down and almost morbid, but are coffin homes coming to the United States? Is this how bad things have become with this lack of housing supply? Now you might be asking yourself, what is a coffin home? Let me start by saying that Hong Kong is probably the best known place that they exist. I'm talking about these tiny subdivided housing units, sometimes as small as 3 feet by 6 feet. They're sometimes known as coffin homes because you can't do much more than lie down in them. They're that small. So this would be a home of about 2 square meters. You might not even be able to stand up inside it. This has been a sad and extreme outcome of the longtime property boom in wealthy Hong Kong. An estimated 200,000 people are priced out of the market. Many live in these partitioned apartments or coffin homes or this other inadequate housing. Some are so small that even lying down, a person cannot fully stretch out their legs. Then you might have 24 separate coffin home residents that share a kitchen and a bathroom that's down a hall in these oftentimes grimy places. Now, I first became aware of these about 5 years ago. Well, I now had the first evidence that American home prices have risen high, and the home supply in America has sunk so low that we now have a model for coffin homes in the United States, in California. A Bay Area startup is offering bunk bed style pods at $800 a month for up to 14 people to live in a single home. Yeah, the name of this year-old startup is called Brownstone Shared Housing. It builds itself as a short-term solution for students or for people working on temporary jobs. That's who they say they serve. It's Palo Alto Home. It houses these 14 people in this house with 2 bathrooms, a kitchen, and fairly plentiful communal spaces. So for $800 a month, residents of the home, which is pretty close to the Stanford campus, they get utilities, internet, a work-from-home space, and access to a sleeping pod. And notice how they use a more genteel name for them than a coffin home. It's a sleeping pod, or some can think of it as a sleeping cocoon. In California, each pod measures 8 feet tall here. Okay, so with what I'm talking about here, you could stand up in it, at least, unlike some of the Hong Kong coffin homes. And it comes with a built-in fan, electrical lighting, a fold-down desk, and a charger for electrical gadgets. The pods are stacked too tall, and they have curtains that close for privacy. What do you think? Is this humane? Is this how we want Americans to live? I think it's heartbreaking to look at photos of this. In fact, I shared this with you in last week's Don't Quit Your Daydream letter, and I'll try to link it in the show notes for you. I mean, I guess it's better than being homeless, but I don't think of this as much of a solution. Is this a dignified existence? These pods are stacked on top of each other like filing cabinets that human bodies kind of slide into. This startup company that I've been telling you about in California, they don't run traditional credit checks on their tenants. Instead, they run a background check to make sure that a potential tenant can live with others. The company's website says, "We evaluate people by the content of their character, not the contents of their bank account." And there's no security deposit, making it easy to move. The co-founder, his last name is Stallworth, he said that most occupants of these sleeping cocoons are in their 20s and 30s, and they're interns, they're people on temporary work assignments, or they're people just starting their careers. And they've taken this model in Palo Alto and they're duplicating it in Bakersfield. Now, Palo Alto, that's high-priced Silicon Valley. Bakersfield, that's cheaper. Bakersfield is inland. Is that concerning to you? Stallworth said that he wants to expand the housing concept to other cities, name-checking Brooklyn, New York as a prime goal. He said the company has signed up 400 interested people in Brooklyn already. The quote that he stated is that there are so many people who aren't doing things because housing is a barrier. Our plans are to go wherever there is the greatest need. Yeah, that's the end of the quote. Now, gosh, is this a disturbing trend or are they meeting a need? I think it's more of the former. Now, some cities, they do have restrictions on the number of unrelated people that are allowed to occupy a dwelling, but they really aren't consistently enforced. The pod houses, they do enforce a no overnight visitors policy in order to keep crowding down. Now, this is hardly a brand new thing, but the trend could be spreading. I mean, in Los Angeles, there have been residents of a co-living complex called Eddie. They pay $795 to $945 a month for a pod bed in a furnished home. That's been going on for a while. Tenants get linen services. They get shared computers and an on-site gym. A chain of residences called PodShare in the LA area charges $50 a night or $1,000 a month for a pod. And once they've paid, residents can move freely among 5 different facilities. PodShare's website says, "We believe that you only really need a small space to yourself to sleep, relax, and store your belongings. The rest of our time should be spent on shared experiences." That's the end of the quote. I don't know, this proliferation of pod-like housing, I find it concerning. It's like a rung below your classic Manhattan studio apartment and one rung above homelessness. Well, I've talked here a fair bit about how America should stop with the housing incentives that assist people on the demand side, like these first-time homebuyer incentives, because that drives up prices. We need help on the supply side. America badly needs it. Hopefully, supply-side help would occur more naturally with more builders building and less government intervention. But you know, the Biden administration, they seem to be doing something about this chronic shortage of housing. Now, this could be big. Last week, a White House press report announced new actions to ease the burden of housing costs. It is a new Biden-Harris administration housing supply action plan to, what they say, help close the housing supply gap in 5 years. Yeah, you heard me right. I said close the housing supply gap. This is, in my opinion, substantially better than giving more money to home buyers, which helps fuel bidding wars and pumps up that demand side. And whether you agree with Biden's means or not, at least they get it. America needs housing, and this Biden plan is too long to completely detail here. I'll link it in the show notes for you. It still makes mention of down payment assistance and rental assistance inside it, which does help the demand side. when we need all-out help on the supply side. But suffice to say, it will reward these areas that have reformed zoning and land use policies. This plan sets out to reduce regulatory hurdles and to scale up ADUs, which some know as mother-in-law apartments. It sets out to provide tax credits to rehab homes for low and middle income buyers and more, and incentivize construction of rural housing and quite a bit more in this plan. So Biden does acknowledge the problem, and he also acknowledges it could take 5 years to put a big dent in this housing supply crisis, and I sure hope that it keeps coffin homes off of our shores. Gosh. I'm really talking about the fate of the housing market here. The fate has more to do with supply than prices. When you think about quality of life for the average American resident, the average person is substantially more affected if they have to live in a coffin than if you're a homeowner and your home value goes up either 5% or 15% over the next year. When it comes to housing prices, this low supply is what keeps providing support, of course. And in fact, I've got a new paradigm for you to understand here. And, I love it when you comment or you write into the show, which you can always do at getricheducation.com/contact. You can either leave an email or a voicemail there. Again, that's at getricheducation.com/contact. Yeah, I love it when you tell me that this here is the show where you learn things about real estate that you don't hear anywhere else. GRE is the only place where you learn certain things that really end up improving your quality of life and your understanding of that vehicle that's made more ordinary people wealthy than anything else, which is real estate. And yeah, I'm talking about more than the 5 ways real estate pays. I'm talking about more than real estate's inflation triple crown, which was also coined here. And financially free beats debt free. Talking about things like your rate of return from home equity is always 0. Yeah, there's some of the more timeless GRE principles that you and I rally around here, but it's also the breakthrough, like I told you about how the housing crash already happened. It was a housing supply crash that occurred more than 2 years ago in April of 2020. This is probably the show where you first learned that higher mortgage interest rates correlate with higher home prices, not lower ones. Almost everyone thinks it's the opposite. That's right. I already explained why that happens on previous shows, so I'm not going to repeat it. And you know what? It has happened again. Mortgage rates have gone up since their all-time low nearly a year and a half ago now. And resultantly, what have home prices done in the last year and a half? They have gone up, right with mortgage interest rates. Well, the new concept that I have to tell you about that you're probably not hearing anywhere else is what happens to housing prices in a recession. In an American economic recession, what happens to housing prices? They rarely fall. In fact, in nominal terms, home prices typically rise right through a recession. Let's look at some recent history here. Just as companies adapted to COVID lockdowns in 2020 and then to worker shortages and rising inflation in 2021, this year they'll have to pivot once again to weather this oncoming storm fueled by higher interest rates and slower growth and more market volatility. And some economists think that that could lead to a recession. And really, the best consensus opinion among economists seems to be that there's about a 1 in 3 chance of a recession over the next year. That's just me talking, distilling down all these reports that I read from economists. So let's talk about that and its effect on housing prices. And I think it's important to state, first of all, what is a recession? It is simply 2 consecutive quarters of GDP contraction. So that basically means 2 quarters in a row of declining year-over-year productivity output. That's all that means. Well, many state that the precursor to falling GDP is a rising unemployment rate. Okay, so let's take a look at that. The unemployment rate was 4% at the start of this year, and unemployment is 3.6% now. It has been falling, and we're also in this strange time where we basically have the opposite of unemployment, because today in America, there are twice as many unfilled jobs as there are unemployed people. Yeah, kind of the opposite of unemployment. And when stimulus checks run out, and when deferring having to make student loan repayments because the federal student loan repayment freeze expires, like it eventually should, well, then people are going to need to snatch up those jobs. So there really are plenty of forces against a recession, and there are also some forces toward a recession. Like we have both hiring freezes in some places and then other places that are giving nice pay raises. Now let's get back to the real estate component of this. Oftentimes I like to look at history to see what happens. There have been 8 economic recessions since the early 1960s in the United States. And through all 8 of those events, housing prices stayed the same or they rose. The only time house prices fell in a recession, just the one time out of those 8 in the last 60 years, was, during the global financial crisis and the mortgage meltdown of 2008 and 2009. That's when we had absurdly high housing supply and absurdly low mortgage underwriting standards. And even then, during that recession, the median American home price only fell from $234K down to $221K. Yeah, I'll link that Fred chart in the show notes for you. So in short there, economists seem to think that there is about a 1 in 3 chance of a recession in the next year or so. And in 7 of the last 8 American recessions, home prices stayed about the same or they increased through that recession. And by the way, if you ever want the show notes for an episode and you don't know how to see them, just use the episode number. This is Get Rich Education Podcast, episode 398. So simply go to GetRichEducation.com/398. Let me get dim and dour for a minute here. Let's say that there was soon an economic recession, and let's say that it even led to a degradation of home prices somehow, even amidst this supply shortage. And I'm really talking about a pretty unlikely event here, but let's play this out. In that scenario, a $5 million trophy property, that is more likely to fall in value than the investor advantage properties that we often discuss here, those properties that are just somewhat below the median American home price. And here's my point. Even in that unlikely scenario, could a $300,000 property even fall to $275K? Is that even possible at all, given these ongoing supply shortages and labor shortages and higher land costs in this permanently higher housing replacement cost era that we're in? It would be really hard for a $300K property to fall to $275K. There is a base replacement cost. So you are well hedged. And you know what? Even if that occurred, $300K down to $275K, you know what's interesting? That is an 8.3% loss. The coincidence is that 8.3%, well, that's actually the latest reported inflation figure. So if you hold on to dollars, you're therefore guaranteed an 8.3% loss in purchasing power. So you want to banish excess dollars and keep putting good property in your portfolio from our network of providers at GRE Marketplace. Fortune magazine just distilled some core logic data into an interesting map called The Odds of a Home Price Dip in Your Area in the Coming Year. And this was done somewhat on a county level, this map. And so to describe this national map to you, almost every area is either in the low category or the very low probability area of a home price dip. And the Midwest and South is just blanketed with those areas almost without fail, every single one of them. And that means that they are so highly improbable to experience a home price dip. In fact, some of the few areas on the map deemed to have even a medium probability of a home price dip are in coastal New England, especially in and around Massachusetts there, and the coastal Pacific Northwest. I saw something funny when it comes to this. Ben Bernanke, the former Fed chair, old helicopter Ben there, I hadn't seen him make any public remarks about anything recently, He was just quoted as saying that no housing price crash is imminent. And yeah, this is the same guy that back in 2007 famously said that the subprime mortgage woes won't spill over into the larger market. Gosh, he was mega wrong there. I don't trust the Fed chairs too much. They're smart people, but their public-facing job is to instill confidence. They're almost always only going to give you sunny side up sorts of things. To review what you've learned so far on the show today is that coffin homes, I think they need to be avoided. The Biden administration has a plan to help real estate on the supply side for a change, that home prices typically stay about the same or they rise in an economic recession, and that the odds of a national home price dip in the next year are quite low, according to Fortune via CoreLogic and other various sources. I want to talk about how special real estate is as an investment class shortly, and how you can specifically use it to build wealth for yourself. But first, I want to share something important with you that just puts investing in your entire life and really all of this stuff we talk about into perspective. It's called What Really Matters. This is about 6 minutes in length. This was recently published on our YouTube channel, and quite a few viewers found some real value in it. If you'd like to watch the video, you can always go to the Get Rich Education YouTube channel before this material fades into obscurity, and you can search What Really Matters. I've got more after this. Have a listen to What Really Matters. If you would have invested $1,000 in JP Morgan in 1882, you'd be dead today. And once you're done having a little laugh about that, realize anthropologists have suggested that you will be forgotten in 3 generations. If you don't believe me, then ask yourself, how well do you really remember your, say, great-grandfather? And I've got to admit, my own recollection of my great-grandfather is really hazy. And even if you do remember yours, do you really remember him well enough such that you would be able to pass it on to your child so that that would be remembered in future generations? When you think about it, what's more important than return on investment is your return on time invested in your life and what you return to others. What's your return on life? It's from living well and having a positive impact on as many other people as you can. Think about your place on your family tree. You are like a conduit with voltage that runs through you. What gets channeled through you? What gets amplified and what's going to be lost? Is there any institution or value that died with you, or did you pass it on? There's good news here. You're the one that gets to cast the vote with your action. You become exemplary. In this world of 8 billion people, you will influence every human that you have a substantial interaction with. We all have this moral battleground inside of us each day as well. What you do, the world sees more of, the world experiences more of. When you think about how fleeting and ephemeral life really is, it can make you pensive and melancholy to reflect on your own mortality, or it can be a tremendous motivator. And you know, I can't help but think that realistically, almost every person is soon forgotten because they never did anything worth remembering. They lived a safe life. A lot of this can be centered around selling their time for money at a job that they didn't like, or being concerned about these trivial things like making sure the floor mats in their car get washed and cleaned the right way, or bigger things like putting off vacations of a lifetime, or never even considering their full potential, like they would only put a visit to outer space on their bucket list and never really try to do those sorts of things, or oh, that's far-fetched, or oh, that would never be me. Most people get used to this settling in life. When you were 12 years old and thought about your adult life, I'll tell you one thing that you never thought, oh yeah, someday I'm going to go out there and live a small life. You never thought that back then. So I hope that you didn't let that happen. I hope that that's not your chosen path, because these things are chosen. You know, I recently had a friend invite me on this beautiful mountain adventure hike, but I thought that I had to go do something else instead. So I was just going to stick around home. I had to move some funds around and initiate a wire transfer for the next investment that I wanted to get into. So I almost told that friend, no, I can't go on the hike. I want to get into this investment today and I have some domestic things to do. But I caught myself just in time. I turned that around and decided to go on the adventure instead. I made the investment later, but I didn't postpone the real opportunity that was right in front of me. I mean, really, investing funds, that's just a claim on the future in the hope that I can buy back that time later to have such an adventure in the future. Too much postponing is an over-reliance on hope. Instead, I live my best life today because I could. Eckhart Tolle said it well in The Power of Now. Most humans are never fully present in the now because unconsciously they believe that the next moment must be more important than this one, but then you miss your whole life, which is never not now. I mean, there's something to be said for delayed gratification, no doubt about it, but the risk with too much delayed gratification is denied gratification. Living well and helping others is infinitely more important than the Fed's interest rate decisions, or housing prices, or rents, or interest rates, or the direction of inflation. It is all so inconsequential amidst the backdrop of what really matters. We don't really want money. We want money to buy us time for things like peace, joy, happiness, expression, love, freedom, a sense of significance, and hopefully goodness too. And I'll admit, I almost forgot that on one recent day. What meaningful things are you really doing with your time? That is your life after all, because your very life is made up of chapters of time. The evanescence of your life shouldn't be sad. This is good. You get to choose. All you can control is the next decision that you make. What's your return on life? For accredited investors, if you've ever wanted 10 to 12% passive income returns, Wagner & Alaska and his professional partners could have the right answer for you with real estate, one of the safest assets available on the planet. On a preferred return basis, you collect your money before anyone else does. I encourage you, go ahead, learn more about their opportunities at I'mAccredited.com or text 305-684-2222 for your free investment guide. Hey, my friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. If you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic, Damian and the EQRP company can fix this. Those IRAs can be converted into EQRPs retroactive to last year, getting those tax deductions and reducing your taxable income. In this way, you can invest your 401k or IRA in real estate, Bitcoin, gold, and even your own business. So whether you're a full-time investor or retired or even a dentist with dozens of employees, if you're listening, you qualify, the EQRP works. It's the solution. You'll control your money, kill UBIT, and pay way less taxes. To learn more about this strategy and free up your retirement money, get the newest EQRP special report. Text GRE to 307-213-3475. That's text GRE to 307-213-3475.
This is Rich Dad, Poor Dad, author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
You're listening to the show that's created more financial freedom for busy people just like you than nearly any show in the world. Welcome back to Get Rich Education. This is episode 398, and I'm your host, Keith Weinhold. Again, if you like the What Really Matters audio, you're really going to like the video. That way you might find more meaning and really get immersed in it there. Again, it is on our Get Rich Education YouTube channel. All GRE videos are free and on our YouTube channel, free just like our Don't Quit Your Daydream letter and like this show. One reason that we can make it free is through our show sponsors. So if you like what we do here, well, just go ahead and support them because they offer services that you often want anyway, like Ridge Lending Group, where we just had Shaylee Ridge here last week, JWB Real Estate Capital in Jacksonville, Florida. They often have available inventory of rental property there. Yes, even in these supply-constrained times because they're such good planners. And then the EQRP company with Damian Lupo. With EQRPs, you legally avoid more tax types than you do with an IRA. So this is a retirement plan. And by having it be an EQRP, you can invest in real estate, gold, Bitcoin, even your own business, and you avoid the little-known bite of the UBIT tax and that bite that it takes oftentimes from IRA holders. Not only can you pay way less in taxes with an EQRP, the contribution limit actually makes it worthwhile. IRA contribution limits are still only about $6,000 a year. It's kind of like, what's the point? Your EQRP contribution limit can be up to $60,000. That is 10x over an IRA, but it's just a strategy that so few people seem to know about. So you probably owe it to yourself to learn at least a little bit more if you think that it can benefit you. And you can do that right now and free up your retirement money. For the newest EQRP special report, just text GRE to 307-213-3475. Damian and his team will get that right over to you. And then finally, Wagner Nolasco, friend of the show here. You know he's been helping you with 1 to 4 unit new build rental property in Florida. If you want to invest more passively and you're an accredited investor, if you've ever wanted 10 to 12% passive income returns, Wagner and his professional partners could have the right answer for you with real estate. On a preferred return basis, you collect your money before anyone else does. So I encourage you, go ahead, learn more about their opportunities at IamAccredited.com. It's kind of funny with the letters there. It's the letter I, the letter M, accredited.com, or text 305-684-2222 for your free investment guide. Yeah, we don't accept donations here at GRE. You can simply support those that support us. Now, one of the easiest ways to get wealthy in real estate is to just continue to borrow against your portfolio's value as it keeps appreciating. And when you make a cash out refinance this way, the IRS does not consider this income. They consider it debt. So you lever up, the property appreciates, and you keep pulling out the cash tax-free and use it for whatever you want to. Yeah, tax-free. This is a lump sum windfall. Some even call this lump sum cash flow, and it is tax-free. So just keep borrowing against your property, and that way you keep the leverage on as well. So look, if you borrow out of your property at a, say, 6 or 7% interest rate, and then you choose to use those funds to reinvest in more real estate, well, as you know, 25% annual returns are common when you add up all the 5 ways that you're paid. You are on your way to financial freedom with an investor mindset rather than a saver's mindset. Again, tax-free. One downside that you got to be mindful of is that when you add debt service to an existing property, you need to stay conscious of your cash flows. So you can borrow out at 7% and then say you are truly reinvesting it for a 25 or 30% total return, where you're still going to need cash flow to service the debt. And an important part of how you do that is with steady rent increases, and I've discussed strategies for doing that here. Your ROI on a new investment usually beats your mortgage interest rate on the cash out. And it's really important to keep this in mind at times like this, where your properties have probably appreciated at a torrid pace as mortgage rates and rents have gone up too. So see, as an active investor, you get to play both sides of this. As an active investor, you should often be out there securing new loans. And if mortgage rates keep climbing, well, then you're less incentivized to refinance and you'll just be more likely to stay put with your low rate. But yet, if mortgage rates fall, well, then you can always make the conscious decision to refinance at that lower rate, playing both sides of it. And be mindful, too, that if you want a lower interest rate, if that's really important to you because, just say you think you're going to hold on to a property for a long time, well, you can make a 25% down payment rather than a 20% down payment. That does often get you a lower interest rate, though you lose some leverage. Or another thing that you can do if you want a lower interest rate because you think you're going to hold on to a property for a while is buy down your interest rate at the closing table by paying discount points. Maybe you want to pay discount points and only put 20% down and get a lower rate that way. See what makes more sense for you. But when we discuss the real estate tax benefits here, oftentimes we center on a 1031 exchange or on the tax depreciation benefit that you get. Keep that tax-free cash out refinance in mind. It's really amazing that you can do all that and yet still hold on to the property. If you're a new investor, or even if you're a repeat investor, though, importantly, you need a vessel for doing this. You need to add vessels or properties. And, you'll never have every single thing just right when you start with property or when you want to add more property. You just got to keep in mind that you cannot time the market. For example, maybe you currently like the market dynamics of low supply and you like that there's responsible lending out there and you like the fact that rents are increasing fast, but you don't like that nominal prices are higher. So you're just never going to have everything line up absolutely perfectly. If you're driving across your city and there are 12 traffic lights, you don't wait for every light to turn green before you start your trip. So I really encourage you to start with the understanding that you cannot time the market. And one important thing to understand in this market is that you must act fast once you have an available property. So if you're a new investor, it's really important to understand that this low national housing supply means that you can't hesitate when a property that falls into your buy box comes on to your doorstep. So it's really this belief in the long-term dimensionality and wealth building power of real estate. So I encourage you, get started with our network of providers at gremarketplace.com. Set up one login, one time, and access all of the national providers. You'll see a video of me over there showing you around the website. Coming up here on the show in future weeks, a lot of great guests, including the return of Tom Wheelwright. It is pretty difficult to time the market. Get started with Investor Advantage Property at gremarketplace.com. I'll see you over there. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.